Hi, and welcome to the Michael Yardney podcast, where we help property investors gain clarity from the chaos in our housing markets to allow them to develop the financial freedom they deserve. Now, in today's episode, it's the monthly Big Picture podcast with Pete Wargent, where we discuss a whole lot of significant macroeconomic factors that property investors and business owners need to understand so that they get some indication of what's ahead. We're going to talk about inflation, interest rates. The number of property investors is falling, Australia's birth rate, job creation, a whole lot of factors that will give you, as I said at the beginning, some clarity for what's ahead. So let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Pete, it's been an interesting month with the Reserve Bank once again holding interest rates on hold. Now, we expected that. So the question now is when are interest rates going to be cut? Look, as I said in the introduction, the gloom that descended on Australia's consumers a couple of years ago seems to be finally showing signs of lifting. Consumer mood has been considerably less bleak. I think on the one hand, buoyed by the additional cash that Australian consumers got over the last little while, and also the expectation of interest rates to start falling. Pete, I remember it was only a couple of months ago there were fears that interest rates would rise again.
Yeah, that seems to have gone away. I guess the most hawkish of the commentators were calling for maybe another 2 or 3 interest rate hikes, because don't forget, Australia didn't take the cash rate target as high as some other countries did. If you think about the US or United Kingdom and so on, our cash rate target appears to have peaked at 4.35%, but inflation is coming down. That disinflationary trend is still intact. So I guess the Reserve Bank would claim that they've been justified in doing that. I guess obviously a bit can change between now and the next figures, but the latest inflation figures anyway showed that disinflationary trend is still ongoing.
Well, there's 2 measurements of inflation, and then they're measured monthly and quarterly. Inflation fell to 2.8%, the slowest pace in more than 3 years. That takes that figure down to within the Reserve Bank's 2 to 3% range. But more importantly, the one that the Reserve Bank's looking at still hasn't fallen enough as yet, Pete.
Well, that's right. So I guess just to explain this in a bit of detail. So you're right, the headline inflation figure for the September quarter was just 0.2%, very, very low. And that takes the annual figure down to 2.8%. which is in the 2 to 3% target range. And that's, as you said, the lowest annual figure we've had since all the way back in March 2021. It's probably going to go a bit further down from here as well. So if you look at where the inflation was, alcohol and tobacco always, we get those sin taxes. And there was some services inflation. So when you look at where that's coming from, rents are still, on the official ABS figures anyway, still pretty hot. Insurance, anyone who's renewed an insurance premium recently would know the insurance costs have gone up an awful lot. And things like childcare costs. Yes, yeah, I mean, it's something that impacts the housing market, of course. But actually, when you look around the rest of the inflation figures, there wasn't much else. I think the big thing, as you said, is that the electricity subsidies from the government actually helped to reduce that headline figure quite significantly. So the Reserve Bank will be keen to see that those core figures, so basically what they call the trimmed mean inflation figures, they want to see that those are coming back down to the target as well, that underlying inflation pulse. And I guess, look, it's always nitpicking when you go down to 2 decimal places, but the trimmed mean inflation figure for the quarter was 0.78%. So if you're really going to be a nitpicker, you'd say, well, you annualize that and it's just above 3%. So there's always a possibility that when the government removes those subsidies, which they might do next year, I'm a skeptic. I think election
maybe
year,
not before an election, Pete.
Exactly. I think if you saw the Queensland election recently, you would know there's a lot of cash that gets thrown around when there's a close election. I guess in theory, it's possible that inflation pops higher again if those subsidies were to be removed. But I think what we'll probably see is that if in the December quarter figures, which are reported in January, I think if the trimmed mean inflation figure comes in at 0.7% or below, then interest rates will be on the way down, probably from February 2025. So a bit can happen between now and then, of course, but that's the most likely outcome, and that's what economists are kind of that's the consensus, I guess, if you were to ask
Well, it's
market
what all the
economists.
big banks, all four big banks in Australia now have agreed or forecast that interest rates are going to drop from February. Some saying they're going to be 3 drops, others 4 and 1.5. I guess we don't really know how low it's going to go. But I think property investors should understand that interest rates in the next decade aren't ever going to get back to what they were a couple of years ago when we enjoyed, let's call them almost wartime interest rates. So on that basis, property investors should plan for relatively higher rates in the next decade than we had in the previous decade, Pete, where the government was having trouble, the Reserve Bank was having trouble keeping inflation up to the 2 or 3% range.
I think so. If you think about why that was the case, Australia was coming down the other side of the mining boom, and there was quite a few headwinds for a number of years there, really since 2012 or 2013. Reserve Bank Governor Michelle Bullock actually talked a little bit about this over the past week or two, and that is if you think about where the neutral rate of for the cash rate target might be. I mean, nobody really knows for sure, but most likely it's probably the midpoint of the inflation target plus 1% or thereabouts. So in plain English, a cash rate target of about 3.5%. So at the moment we're above that, and that's quite contractionary for the economy. But maybe that neutral rate is somewhere around mid threes or something like that. So I wouldn't be anticipating that interest rates are heading back towards zero or anything quite so extreme again.
No. Look, one of the other things the Reserve Bank has been looking at, of course, is the unemployment figures, the jobless figures, how many people have got jobs. It was wanting to raise the unemployment figures a little bit by, in that way, slowing down inflation, slowing down employment, slowing down wage growth. But having said that, the last figures, and this is the trouble with a lot of these figures, Pete, they're retrospective, just like the quarterly CPI figures you spoke about a moment ago. They're going to be quite retrospective. But the unemployment figures showed job creation's been booming.
Pretty good, really, when you think about it. In September, the reported employment figures rose by 64,000 up to 14.5 million. So that's the highest number of Aussies ever that's been employed. Most of those employment gains were full-time as well. There was a little bit of a blip, if you remember, back around February and March. Maybe that was a seasonality issue. But we've really had six employment reports in a row that have been very, very solid. Employment's up over the past year by 1%. So that's about 435,000 Aussies. The participation rate, 67.2%, the highest it's ever been. And the unemployment rate, if you look at the trend, it's really been flat for about the past 4 months at only 4.1%. So, yeah, it's interesting. Michelle Bullock said if you went back to pre-COVID, if you'd have said, well, we could have an unemployment rate of around 4, they wouldn't have even believed that. So,
No,
yeah, and, if you look at why that's the case, job advertisements have stayed pretty high, but a lot of the jobs have been in the public sector, healthcare, NDIS jobs. So I think the government spending has accounted for quite a lot of it. But I guess, if you look at Australia compared to a lot of other countries like Canada, where they've had high population growth, the unemployment rate there is mid-sixes. So we're doing a hell of a lot better than some other countries, and we should probably be grateful for that.
Yes. Well, you living in Queensland recently had your local elections. Currently, Australia is getting ready for a federal election next year. And it's fairly standard practice when an election is in sight for one side or the other, or both sides, to start wanting to get voters, and currently a couple of the parties are demonising property investors. Look, I believe that the next federal election really doesn't have to be held until September 2025. I know a lot of people were talking about it maybe being in May next year, but I guess the government's going to want to see interest rates falling, the economy doing better. But I can't see either party wanting to get rid of negative gearing. That's been a discussion in the last little while. It came out and has been put to bed again. But I think some of the loudest detractors, that party with a particular colour in its name, really don't understand the role of property investors in supplying a service that's required that the government and no one else is filling at the moment, Pete.
You're right. So yes, negative gearing and capital gains tax, they seem to get an airing every election cycle. And the Treasurer, Jim Chalmers, said that they took a look at it, but they weren't convinced that making changes would be beneficial to the housing supply. So an awful lot of the focus in this election cycle would be on how to build more homes. Labour Party has launched its Housing Australia Future Fund, which hasn't delivered much today, but is expected, I suppose, over 5 years to build around 30,000 affordable homes at a cost of around 10 billion. So that's one policy. I think the coalition will be looking at things like early access to superannuation for first home buyers. That's more of a demand side policy. But also, as you mentioned, there's that's the federal election, but there's also the state governments and what they're looking to do. So down your way in Victoria, Jacinta Allen said Victoria will be slashing stamp duty on off the plan apartments for every buyer with no cap. So that includes townhouses and units. So, and that's a 12-month stimulus, probably targeting more apartments, more townhouses and units down in Victoria. I think the challenge is at the moment is that a lot of those projects just aren't stacking up for developers. Interest rates we mentioned, but the cost of construction has gone up. There's shortages of labour because a lot of people are working on big mining and infrastructure projects. So I think maybe an election flashpoint might be policies around population growth and whether that needs to be cut back a bit.
Well, let's talk about the stamp duty a bit because, yes, it is a cost that no one likes paying, but I'd rather pay a cost and buy an investment grade property as an investor because, sure, some first home buyers will benefit from the stamp duty saving. It will get them into the property market. But we know last time there was a building boom when there were incentives to build lots of apartments. We ended up with what I think are going to be the slums of the future. There are so many buildings with problems, building problems, so many apartment towers that are having challenges. So I'm not sure that as an investor you should be getting in just because you get a one-off benefit. More importantly is to get what you'd call an investment grade property, Pete.
I'd be very cautious personally, not least because building firms are going insolvent all over the place. I think a lot of construction firms took on fixed price contracts during the home builder stimulus and they're now turning insolvent. But also I think, like yourself, I've been an advisor in the property market for many years, and more often than not when I see people in sticky situations, it's because somewhere along the line they bought an off the plan development of some description. There's no scarcity in the product. Usually you pay a premium to buy brand new. And I think sometimes people are lured in by the tax benefits, the depreciation, but I guess they overlook that, in the end, the property itself is depreciating. Very often, 5, 6, 7 years down the track, you find that the price has actually gone backwards. So that's not
Yeah.
just an opinion. It's just statistically borne out. CoreLogic have these loss on resale reports, and it's very often people who buy brand new who get caught out. So caveat emptor, I would think.
I think the other thing one's got to remember is that the tax incentives can help in the short term create a little bit of supply, but it takes so long to get these properties out of the ground. Now, Victorian rules say doesn't matter. It's when you sign the contract, even though it's going to take a couple of years to get things out of the ground. But recently, the Master Builders Association showed that it's taking 40% longer than it did 15 years ago to build a house from building approval to completion, and about 33% longer for apartments, just because of all the challenges, if they can even make them financially viable. Pete, Pam and I were just recently in New Zealand. I was the keynote speaker at the New Zealand Property Investors Federation, and it was fascinating to see how their property market slumped terribly when the previous Labor New Zealand government interfered with taxes. They took away the ability to claim interest at all against your investment properties. It fiddled with capital gains tax. It's actually a negative gearing. It's actually now reinstated those. What it caused was a flood of people leaving the market, investors not getting in, investors were disheartened, fewer rental properties at a time when vacancy rates were already low in New Zealand. And so any of the potential benefits of price falls that the government then said, like our government here saying, we want to make things more affordable, actually it didn't really work. The short-term problem of benefits, I guess, were effectively traded off against a squeeze in supply that's created all sorts of issues.
Yes, and I guess closer to home for me in the United Kingdom, we had very similar issues. I think if you look at Australia, very, very little social housing actually gets built now, or public housing. There was a little bit during the Rudd stimulus, during the global financial crisis. But if you look generally now, as a percentage of the stock, it's a tiny amount of housing that gets built by the government. So where's the new supply going to come from? In the UK, build to rent is now quite a significant portion of new supply. But just like you talked about in New Zealand, there was a winding back of tax deductibility on interest for landlords in the UK. And surprise, surprise, a few years down the track, housing crisis, not enough housing's being built, rents are through the roof, and so on. So, yeah, it's a familiar story. I think in the end, we still need investors. Australia is a high population growth country. About 30% of Australians, including myself, were actually born overseas. And if you include people with a foreign born parent, that's over half. So it's a high immigration country where we're definitely going to need rental housing. And you can't really rely on the government to do that. I think there's a big push from the Labour Party towards big corporates and super funds to invest in build to rent housing. But in the end, most people who come to Australia are aspirational. And I think really we need landlords and they shouldn't be disincentivized.
Well, interesting that you say that, because there was recently an article in the Financial Review which showed that the number of investors has fallen. The percentage of investors has dropped. The absolute number of property investors dropped from 2.29 in 2021-22. Sorry, dropped to 2.29 from 2.39. There's 100,000 less property investors. But it also showed that there's fewer investors now even claiming negative gearing, which almost goes against the stories that the media are telling us.
Yes, and it's not unrelated to the lack of new supply. I think if you went back to the previous cycle, there was a lot of new apartments bought by super funds, investors. There was also non-resident investors. This time around, not so much. I think maybe a lot of people got burned first in the previous cycle, and non-residents have to pay a stamp duty surcharge. So if you look at we desperately need supply in Australia. House approvals have picked up in Perth and to some degree in Melbourne and Brisbane, but unit approvals are just a mess. I think even now they're down double digits from a year earlier. Melbourne and Brisbane, not really much being approved. Sydney, there was 660 unit approvals in September. I think if you just take out one very seasonally weak month in January 2023, you'd have to go back a dozen years to see a lower figure. So, yeah, it's all well and good sort of squeezing landlords out of the market, but where's the new supply going to come from? I think in the modern housing market, investors amplify the cycle on the way up and down. And if you don't have investors buying new apartments and new houses, the supply is just not going to keep pace.
Well, interestingly, that article in the Financial Review was called "Has Australia Passed Peak Property Investors?" Because I know when I first started investing in the 70s, not that many people were doing it. There weren't books, there weren't podcasts, there weren't blogs around. It was suggested that in 1980, only 5% of taxpayers had property investments. And the way that's shown is because they show rental income. In 2014, it peaked at 21%. So from 5% to 21% of Australians were property investors. And then over the last while, it's slowly fallen. The percentage has fallen, and it started falling, I guess, in 2017. Remember, APRA came in to regulate investors. That made the banks look at investors differently to home buyers. So be careful what you ask for, what you look at, Mr. Government, because look what happened in New Zealand, look what happened overseas. As you said, the government requires rental property providers, mums and dads, to be able to provide a service that the government just can't do, Pete.
That's true. I think as well, it sometimes sounds like a lot when you talk about, say, 20% of taxpayers, but very often you find when you actually drill into those numbers, a lot of people end up as accidental landlords. So you just think back, even through my own journey, I bought a place myself and then start a relationship, and you decide to cohabit, and you keep hold of the other property as a rental, and you become almost like an accidental landlord.
Yes.
But when you look at the number of professional landlords, properties with, let's say, 6 properties or more, very, very few really as a percentage. And it's actually quite disincentivized in Australia anyway, because as you would know, once you go beyond a certain point, the land taxes start to kick in, and it becomes, for a lot of people, they just don't want the headaches of paying the annual land taxes, continual changes to tenancy rules and tenancy rights and all of that kind of thing. So yeah, I think sometimes we do make it pretty difficult. And yeah, we're going to need more rental housing. If you look at the rate of population growth in Australia, it's very, very high. So yeah, it's a bit of a pressure cooker situation that's building up now.
Well, one of the challenges investors have got is land tax, as you say, but they tend to forget that land tax is tax deductible. It's the only tax it is, because it's a state tax and your other taxes are basically a federal tax. What you've got to look at is the total picture. Maybe the last discussion I'd like to have with you in today's Big Picture podcast is some other stories that have come out about our birth rate in Australia reaching the lowest levels on record. And the reason is often given that just the cost of living is putting people's families having babies off. Now, I know in a recent Demographics Decoded podcast that I did with Simon Kirstenmacher, we spoke about the millennials and how they're not just putting off having babies, but they're putting off putting their roots down, buying homes. They're having a gap year. They're going overseas. They're not putting the roots down into a job straight away. So while there's no doubt that the cost of living is slowing some people down and they can't afford to miss out one income or have a baby, I think there are other factors involved as well, Pete.
I think so. I mean, a decent case study myself. I was never in a big rush to get married, settle down, have kids, because why would you? There's lots of, there's a whole world to see
Fun
out
stuff
there.
to do.
Yeah, that's right. I want to have a gap year, go and travel, go backpacking, maybe take a sabbatical year. There's no rush, I guess, to settle down and have kids these days. And in fact, in my case, late 30s before we even got around to it. So I think, yeah, on average, people are still having kids, they're still getting married, but they're doing a lot of things later than they used to. Australia doesn't have a dramatically aging population like some other parts of the world, but it's still a challenge. And I think if you actually look at the latest population growth figures, 615,000 over the year, very high, 2.3%. But the natural growth of the population, i.e. Births minus deaths, was only 105,000. So it's not contributing as much as it used to. I guess more people dying as we get older, and birth rates and fertility rates slipping down lower as well. So it shows the importance of immigration, really, because it drives all of those figures now.
Yes.
Whether on the way up or the way down, it really amplifies the figures. So Australia is pretty good on that generally. Skills-based immigration system, pretty good at assimilating new arrivals and so on. But yeah, that will be an election focal point, I think, because infrastructure is struggling at the moment with a population growth at 2.3%. And in some parts of the country, like southeast Queensland or Western Australia, just not keeping pace at all, really, with the housing and infrastructure that's needed.
Well, we do need the people to pay the taxes, for one thing, as baby boomers retire, because the government's going to have difficulty. We know it's already having difficulty making ends meet, and it's going to have more pensions to pay as people are retiring, more healthcare, more NDIS, and so it's going to require more people at tax-paying age. So I can't see population growth from immigration slowing anytime soon. And that, of course, just feeds into what we both keep saying, that we're going to need more housing. Things are going to just continue on. And I see 2025 as being a good year for property. Eventually interest rates are going to fall, whether it's February, whether it's their May meeting, and that's going to increase consumer confidence, increase the ability to borrow, but it won't be the same for everybody. As I see it, Pete, still some people, and it's not a judge of people, but people in lower socioeconomic groups are probably going to have difficulty borrowing more. They're still going to be affected by the cost of living. On the other hand, there's going to be people who've got equity in their homes, who've got multiple streams of income, share investments, business investments, who are going to be able to borrow more. And as the next phase of the cycle starts, I think it'll be the same as the beginning of every new property cycle. It starts at the top end and then slowly trickles down.
I think it's arguably already happening. I think if you look at investment loans, they're up about 30% from a year earlier. I think that's come as a real surprise to a lot of people, including the Reserve Bank. It looks unusual because the average loan size is rebounded, in fact, increased back to a record high. But I think part of the reason is that, as you mentioned, lower income earners, they're being stress tested for very high mortgage rates of maybe 9.5% that they're never going to pay. And so the people who are coming back into the market early ahead of interest rate cuts are people with equity in their own homes, higher income earners, people with inherited wealth. And because some of the lower income earners are effectively locked out by APRA's lending assessment buffers, it's kind of skewing the market towards it's skewing the averages higher towards wealthier borrowers. So I think what's happening is a lot of investors are anticipating interest rate cuts over the next 6, 12, 18 months, and they're getting in ahead of time, which
Yes,
kind of does make sense if you think about it.
it does. And of course, there's the bank of mum and dad helping a small group of people as well. Now, Pete, the other bit of news I got this month was that another one of your books came out. You're so prolific. So first of all, there's the book with Kate Bakos. Maybe we can have a quick chat about that, and then you can tell us about your other book as well. How's the first one coming out?
Yeah, so Kate and I, we co-authored the Buy Right Approach to Property Investing, which I think we've mentioned on a previous podcast.
Yep,
And you can see that one in the airport stores or in Dimmicks and so on. And the subtitle is Mastering the Skills to Invest Wisely in Property. You're right, though. We do actually have, along with Michael Wilkinson, a good friend of yours,
yes,
the new Wealth Way, Unlock the Power of Compounding. Yeah, I've been working on that one. It's a bit of it's a reworking of an earlier book.
yep,
There's been quite a lot of changes, really, since I first wrote that book. And sometimes it's funny, I was talking to a friend of ours, Stuart Weems. You sometimes reread things that you wrote years ago and you think, oh, gosh, that didn't work out as planned. But it's held up pretty well. And I've just wanted to move it into 2024 because we're in a different environment now, different interest rates, different outlook, and so on. So a lot of the principles are the same. It's about unlocking the power of compound growth. But yeah, some of the specifics have updated over the years as well.
Well, what I'm going to do is leave a link in the show notes to both of those so people will have the ability to get them. And I remember when I first approached you hey, can we write some of your articles in Property Update way back when you wrote your first book? That was a long time ago, wasn't it?
2011, I think it was. I think if you remember back in the early days of Property Update, there was Michael Matusik, and you were one of the main contributors. And I remember you inviting me to add a few blogs. That was fantastic. It's a few years under the bridge now. I think it was 2011. So
amazing.
Yes,
and out of that's come a good friendship. And boy, just the market for this information has grown. The other interesting thing is there's been a lot of people that have come and gone in that period of time. That's one of the great lessons I've learned. I know you have also. Be careful who you listen to, because it's really easy to sound good when you've experienced a once in a generation boom like we did a couple of years ago. But when you've got people like you who've been doing this for a number of decades, Stuart Weems, me, we learn lessons along the way and we fine tune our strategies. So as you say, the strategies haven't changed. They've just been tweaked a bit for the current times.
I think when you actually look at it, there's three ingredients to creating wealth. One is leverage, however that's defined for you. Second one is compound growth. And the third one, the magic ingredient, is time. And if you don't have a strategy that's going to work for you over the years and over the decades and the cycles, then you don't get the magic ingredient of time. So you're right, you do need to do what's proven and what works, and something that you can keep repeating and keep benefiting from that multiplication effect. So yes, you're right. I mean, you do need to sort of tweak and update your strategies as you go, but the basic principles don't really change.
Well, I look forward to catching up with you for our next Big Picture podcast, but I'd also like to catch up with you for a separate discussion about maybe some of the lessons you learned from 2024, some of your predictions for 25, and we can include some of the thoughts in both of your books, because I'm sure there'll be good lessons for our listeners and our viewers. Look forward to catching up with you again real soon, Pete.
Always a pleasure. Thanks, Michael.
Before I have my regular popular mindset message with you, I'd like to just follow on some of the thoughts we discussed with Pete Wargent, where he and I believe 2025 is going to be a good year for property. I don't think we're going to get the double-digit growth like we've experienced in a number of the states in 2024, because property values have risen a bit too much, and now some of those markets are getting close to the peak of their cycle. I'm not suggesting the property values are going to fall, but also I think it's important when you, as a property investor, put your plans together to have a long-term focus and not look at the next hotspot, but see where there are going to be multiple growth drivers to grow the value of your properties. And that's why we only invest in the capital cities of Australia and only in certain regions in the capital cities as well. 2025 is going to be when interest rates fall. And as Pete and I said, certain segments of the market are going to be able to borrow. And that's going to create the next wave in the property cycle, as it always does. How are you going to take advantage of it? Have you got plans that are going to protect your assets and also help them grow and outperform the markets? If you'd like some assistance, why not have a complimentary wealth discovery chat with one of the wealth strategists at Metropole? Remember, we're much more than just another buyer's agent. We help our clients safely outperform the markets by giving strategic property and wealth advice. We're going to help you plan to become the property investor you plan to become. As I said, we're much more than just a buyer's agency. We help you with personalised investment plans. We've got a deep market knowledge. We've got all the data and research, but much more than that, decades of experience to be able to have the perspective to understand what the data and research shows. I'm finding currently a lot of the new breed of buyer's agents and investors who are not using buyer's agents are using the same data to go to the same spots and push up property values beyond underlying fundamentals because they're all working on the same set of data and maybe not having a forward-looking set of data. They're all using historical data. So what we do is have a look at where there's going to be economic growth, which is going to lead to jobs growth, which is going to lead to population growth, which is going to lead eventually to house prices and rents going up. But at Metropole, we have a complete range of services, including wealth advisory, property acquisition, property development, finance, construction, and property management. So we've got a proven track record. Interestingly, a recent audit of our clients showed that they're 7.3 times more likely than the average investor to own 6 or more properties. I guess they made the right decisions because they got the right advice. So why not have a chat with one of our wealth strategists? Go to metropole.com.au. I'll leave a link in the show notes.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I want to share with you a habit, a daily tool that the rich use that never occurs to most people. You see, over the years, I've worked with many successful property investors and business people, and I found they use a daily tool that helps them achieve what they want to achieve. Now, we've all heard about to-do lists. The best to-do lists incorporate daily activities to help you move forward in life towards accomplishing your goals. But to-do lists alone aren't going to make you successful, in my opinion. While it's important to get things done, I think it's equally important to avoid doing things that wash out all the benefits of a to-do list. You've probably never heard of a to-don't list before, but I discovered this little-known secret strategy of most successful property investors many years ago. You see, a to-don't list includes all the things you should never do because they're either time wasters, bad habits, or things that hold you back from having a happy and successful life. To-don't lists, in my mind, are just as important as to-do lists. Most successful people foster accomplishments in their lives by diligently doing certain things every day and diligently avoiding certain activities. Now, unfortunately, most people aren't as successful in their life as they want to be. They eke out a living, they struggle to get by. Most property investors never get past their first property. They're unaware that they're engaging in destructive habits on a daily basis that make success impossible for them. They're engaging in habits that might appear on a typical to-don't list. For example, they're watching lots of TV every day or listening to lots of podcasts or watching things on YouTube or wasting time on Facebook, Twitter, Instagram. Now, I'm not saying don't enjoy yourself, but if you are going to be watching or reading, what you should be doing is doing some that's enjoyment, but also some that's learning. But of course, you've got to be careful who you listen to because there's so much false information out there on social media. Also on their to-don't list is don't envy anybody today. Don't make impulsive purchases today. Don't gossip. Don't gamble. Don't drink in excess. Don't lose your temper. Another important thing on your to-don't list is don't ignore your family. Don't read negative news. It's too easy to get sucked in the negative news cycle that makes you feel unpleasant and uncomfortable about the future, when in general we're living in great times. Okay, another thing on your to-don't list should be don't procrastinate today. Don't ridicule anyone today. Don't hate anyone today. Don't smoke a cigarette today, and don't be negative. For those of us who've got bad habits, and we all do, including me, maybe I should put on there, don't eat more chocolate. But for those who've got bad habits, to-don't lists may even be more important than to-do lists. To-don't lists help you keep aware of the things you shouldn't be doing. Knowing what not to do, in my mind, as I said, is just as important in achieving success as knowing what to do. So have a think about it. My message to you today is, what would be on your don't to-do list? When you ask yourself that question, only then will you become aware of the daily habits that are constantly pulling you backwards. To-dos, while a great tool, help improve your chances of success, but they only get you halfway there. The message is, to-don't lists take you the rest of the way. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. And I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcast, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.